What's up guys, welcome back to another video of mine. I hope you're all doing well, as today we're going to talk about one of the, in my opinion, most promising dividend tech companies currently out there on the market. And that is Cisco. For this video I decided to implement some minor changes to the style of these videos, which you will notice while we go along with the video. But let's start out with the usual brief introduction. Cisco is an information technology company which focuses on the sales, manufacturing, and design of internet protocols, as well as other networking based and related services. They are currently based, as you can probably guess, in the US, or to be specific, in California. But now let's have a brief look at the key financials which Cisco has to bring to the table. As per usual, let's start out with the company's market cap, which currently sits at right about 177.7 billion US dollars. This is somewhat on the bigger scale of the more medium cap companies, but it indicates that Cisco is indeed fairly popular around investors. Most likely all of you know that this valuation does not come out of thin air and can be attributed to a couple of reasons, like for example the revenue of the last fiscal year. For the case of Cisco, this exact revenue set at right about 49.3 billion US dollars, which is a small drop to the previous year. But let's break that revenue down a little bit further. In the first place, we got the infrastructure platforms, which contribute about 28.6 billion to the revenue. This is then followed by services provided by Cisco with about 12.3 billion. In the third place, we got applications that are either licensed or designed by Cisco, which make up about 5.4 billion. In the fourth place, we have a minor contributor with security solutions and products with about 2.5 billion. Last but not least, we still have the other income sources, which contribute the missing 490 million US dollars. But enough with the introduction, which we now have knocked out of the way. Let's move on to something which you probably all want to know about, which are the distributions to shareholders. At the current point of time, Cisco rewards their shareholders through the two most common distribution forms, which are dividends and stock buybacks. At first, let's focus on a dividend, however, which at the current point of time sits at right about $1.44, equaling a yield of about 3.41% at the current price point. But while we've now talked about the current distributions, let's also have a look at the past distribution history, as this can indicate how focused on the dividend a company actually is. For the case of Cisco, we can recreate the first payment of a dividend to the year of 2011, which is also right about the time at which the company started constantly increasing their dividend from year to year. This indicates to us that while Cisco is still fairly young when it comes to using a dividend, they are trying to build a lasting distribution policy for their shareholders, which can also be seen with the low payout ratio when it comes to the dividend. But in order to find out whether this distribution policy in general is also sustainable, let's have a look at the numbers. In order to do that, we have to put the total distributions, which includes the dividend and the amount spent on stock buybacks, into contrast with the free cash flow. Right from the bat, we are able to say that generally speaking, the distributions stay below the free cash flow, except for the year of 2018 and 2019. In these 2 years, the free cash flow is exceeded quite a bit, which however is still fine, although you would not want this to occur on a frequent basis. But obviously the distributions aren't everything, and can sometimes only paint half the picture. So let's take a closer look at the financials of Cisco by having a look at the balance sheet and also going deeper on why the distributions in 2018 and 2019 are still fine. As per usual, let's start out with the year of 2016, in which Cisco's total assets sat at about 121.6 billion. These were made up by about 78.7 billion in equity, 24.5 billion in long-term debt, 4.2 billion in current debt, and 14.3 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using the company's debt and its cash position. For the case of Cisco, we get a net debt position of about 0. This can easily be attributed to the high cash position, which the company bolsters on its balance sheet, which is also the reason why I've previously said that with these kind of cash reserves, you can allow yourself to offer higher distributions for 2 to 3 years. But let's do the same thing for the year of 2020. As you are able to see, Cisco's total assets somewhat decreased, and in the year of 2020 only sat at about 94.8 billion. These were made up by about 43.6 billion in equity, 11.5 billion in long-term debt, 3 billion in current debt, and 36.7 billion in non-interest-paying capital. But let's again calculate our net debt position for the year of 2020, which would come out to be a net debt of about $0. Therefore, it does not really make sense to even try and calculate how sustainable the company's debt actually is, as Cisco could pay it down instantly, which is indicated by having no net debt, obviously. From this, we can conclude that Cisco's shareholders do not have to worry about higher distributions for a limited time. In addition to that, we can also draw the conclusion that Cisco has a quite decent backlog of capital, which they can also use to invest into businesses. Alright, after having all of the financials covered, we still want to take a closer look at the company, which will also influence our margin of safety later on. First of all, let me point out one of the weaknesses I see with Cisco, which is also fairly recent, as you could say. And this is connected to the results of the last quarter of the fiscal year 2020. Although Cisco beat expectations, which were largely adjusted for the whole COVID situation, this is only somewhat of an accurate picture, as the majority of this earnings beat came from a tax credit. If you, however, ignore this tax credit, the initial decent earnings beat actually reveals a business which has taken a fairly decent hit by the COVID pandemic. Although this might not have enormous long-term effects, it still is a hit from which the company has to recover at first. Especially since it might change how a lot of companies across the globe and in the US work, as these are the main customers of Cisco. Therefore, I'm going to add 5% to my margin of safety. But the recent months didn't really ruin the overall outlook for Cisco in my opinion, as the company is still in an absolutely great market position, especially when it comes to the market of cloud security, which actually grew throughout this quarter. This not only positions them already fairly well in a more and more important market, but actually indicates that if crap hits the fan, they could capitalize further on this business segment. Therefore, I'm this time going to reduce my margin of safety by about 5%. My next point is also actually somewhat connected to the previous one, and that is the extremely strong balance sheet which Cisco brings to the table. Not only do they not have any net debt, which nowadays is fairly uncommon, but they are swimming in a huge pile of cash. This allows them to invest strongly in their already existing systems, but to also be able to go through with mergers and acquisitions, which in my opinion could become a driving force in the growth of Cisco. And for this exact reason, I'm going to reduce my margin of safety by another 10%, leaving me with an overall safety margin of 15%. But let's actually find out how much I would be willing to pay per share of the company. In order to get the fair value of the stock, we have to take a little look at the historic dividend yield. For the past 10 years, we had an average dividend yield of 2.72%. This obviously means that you want to buy the stock if the yield is above that average. This would mean with the current dividend of $1.44, a fair price to pay would be $52.94. If we now want to calculate the value I would pay for the stock personally, all we have to do is again get the average dividend yield of 2.72 and my safety margin of 15%. This gives us our target yield of 3.12%, which leaves us with a price to buy the company at of $46.15. Therefore, I'm currently rating Cisco stock a personal buy in my portfolio, which I would consider buying as soon as I add further capital to my portfolio.